My friends, in my decades of observing Wall Street, I have witnessed countless fortunes made and lost. I have seen brilliant men reduced to paupers and careful men build wealth that spans generations. And through it all, one truth has remained constant, unchanging, eternal. First rule of investing is not to lose money. The second rule is never to forget the first rule. But today, I want to share with you something more specific. Not a strategy, not a technique, but a single fundamental rule stands between you and financial ruin, a principle so powerful yet so simple that most investors ignore it to their peril. This rule has protected my students through the Great Depression, through market crashes, through manias and panics. It has made fortunes for those wise enough to follow it, and its absence has destroyed the wealth of those arrogant enough to dismiss it. I speak, of course, of the margin of safety. Today, I will explain why this single concept is the only true protection you have against losing money in the stock market. I will show you how to calculate it, how to apply it, and why ignoring it is the fastest path to financial destruction. Let me begin with a question that should trouble every investor. Why do intelligent people lose money in the stock market? It is not because they are stupid. Many of the brightest minds I have known have lost fortunes. It is not because they lack information. In today's world, information flows like water. It is not even because they lack skill in analysis. No, my friends, intelligent people lose money for one simple reason. They pay too much. You see, every investment has an intrinsic value. This is what the business is actually worth based on its earnings, its assets, its future prospects. This intrinsic value is a fact, though it may be obscured by the emotions and speculations of the market. But then there is price, and price is what you pay. Price is determined by the mood of the market, by fear and greed, by optimism and pessimism. Price fluctuates wildly while intrinsic value changes slowly. When price exceeds intrinsic value, you have overpaid. And when you overpay, you are virtually guaranteed to lose money, either immediately or over time. This is mathematical certainty, not opinion. The tragic irony is that most investors do their buying when prices are highest, when optimism is greatest, when everyone agrees that stocks can only go up. They convince themselves that the rules of arithmetic have been suspended by a new era. Now, let me explain the margin of safety, for this is the foundation upon which all sound investment must rest. The margin of safety is simply the difference between the intrinsic value of a business and the price you pay for it. If a company is worth $100 per share and you pay $70, your margin of safety is $30 or 30%. This margin is your cushion against error, against bad luck, against the 1,000 natural shocks that businesses face. It is your protection against your own inevitable mistakes and calculation. It is the only thing standing between you and the loss of your capital. Consider a simple analogy. If you are building a bridge to carry 10,000 pounds, you do not engineer it to hold exactly 10,000 pounds. You build it to hold 15,000, 20,000, perhaps 30,000 pounds. Why? Because you know your calculations might be wrong, because materials might be weaker than expected, because extraordinary stresses might occur. The margin of safety in bridge building prevents collapse. The margin of safety in investing prevents losses. But here's what most investors fail to understand. The margin of safety is not a luxury for the overcautious. It is not conservative hesitation. It is mathematical necessity. Let me demonstrate with arithmetic that even a child can understand. If you buy a stock for $90 that is worth $100, you have a margin of safety of only 10%. If your estimate of value is wrong by 15% and the company is only worth $85, you have lost money despite doing careful analysis. But if you buy that same stock for $70 with a 30% margin of safety, your estimate can be wrong by 30% before you lose your principal. This company could be worth only $70 and you break even. This is the power of the margin. The margin of safety does not guarantee profit. Nothing can guarantee that, but it tilts the odds dramatically in your favor. It transforms speculation into investment. It makes the difference between gambling and sound business judgment. Now, I know what you are thinking. Mr. Graham, this sounds reasonable in theory, but how do I actually calculate intrinsic value? How do I know what margin of safety I have? This is the right question, and I will give you the honest answer. Calculating intrinsic value is part art, part science. It requires judgment, but it is far from impossible, and the process itself protects you. First, examine the company's earnings, not the earnings it hopes to make. not the earnings an analyst promises. The actual earnings, it is demonstrated over multiple years through good times and bad. I like to look at average earnings over 7 to 10 years to smooth out fluctuations. A simple conservative approach. Take the average earnings per share over the past 7 years. Multiply by 15 if the company is stable, by 10 if it faces challenges. This gives you a reasonable estimate of intrinsic value. For example, if a company has averaged $5 per share in earnings over 7 years, and it is a stable business, its intrinsic value might be $75 per share. If you can buy it for $50, you have a margin of safety of 33%. Second, examine the balance sheet. What are the company's assets? What are its liabilities? In some cases, particularly with troubled companies, the assets alone provide a margin of safety. If a company has $40 per share in liquid assets and you can buy the stock for $30, you have a margin of safety, even if the business earns nothing. Third, and this is crucial, be conservative in every assumption. When in doubt, assume less. Estimate lower earnings. Value assets at less than book value. Expect problems. The margin of safety is built on pessimism that proves to be excessive, not optimism that proves to be insufficient. Remember, my friends, it is better to be approximately right than precisely wrong. I would rather buy a company worth somewhere between $70 and $90 for $50 than buy a company worth exactly $100 for $95. The first investment has a margin of safety. The second is speculation masquerading as precision. Now we come to the most difficult part, not the mathematics, not the analysis, but the psychology. You see, stocks with an adequate margin of safety are rarely popular. They are often out of favor. Sometimes they are in industries people fear. Sometimes the companies have had disappointing recent results. Often other investors are selling while you should be buying. This creates enormous psychological pressure. The human mind rebels against buying what others are abandoning. We are social creatures. We want confirmation. We want consensus. We want to feel that our decision is validated by the approval of others. But the margin of safety exists precisely because others have created it through their selling. When a stock worth $80 falls to $50, it is because other investors have become too pessimistic. They have overreacted to bad news. They have extrapolated temporary problems into permanent catastrophes. This is your opportunity, but only if you have the emotional fortitude to act when others panic. I have seen this pattern repeat endlessly. In the depths of the Depression, magnificent companies sold for less than their cash holdings, not because they were worthless, but because fear had overwhelmed reason. Those with the courage to buy the proper margin of safety made fortunes. In every market crash, the same opportunity presents itself. Solid businesses become available at prices that provide enormous margins of safety. But the headlines scream disaster. Your neighbors are selling. The experts on television predict further declines. This is precisely when you must remember the margin of safety. If a company is worth $100 and you can buy it for $50, it does not matter if it falls to $40 tomorrow. In fact, if you have additional capital, you should buy more. Your margin of safety has increased. The market is there to serve you, not to instruct you. Its job is to provide you with opportunities to buy low and sell high, but it will only do so if you have the discipline to act contrary to the crowd. Let me share with you the most common mistakes I have observed in my years on Wall Street, mistakes that destroy the margin of safety, mistakes that you must avoid. First, the mistake of false precision. Some analysts will tell you that a company is worth exactly $93.47 per share. They have elaborate models. They have spreadsheets with projections extending 10 years into the future. They have calculated terminal values and discount rates to 3 decimal places. This is nonsense. The future is uncertain. Earnings will fluctuate. Competitive conditions will change. A valuation accurate to the penny is a fantasy. Instead, think in ranges. The company is worth somewhere between $70 and $90. That is sufficient for decision-making with a margin of safety. Second, the mistake of paying for the future. Many investors pay high prices because they believe a company will grow rapidly. Perhaps it will. But growth is the most uncertain element of value. It depends on management execution, on competition, on economic conditions, on consumer preferences. When you pay a high price for expected growth, you have no margin of safety. If the growth materializes somewhat slower than expected, you lose money. If it fails to materialize at all, you lose a great deal of money. Buy companies at prices that are justified by current earnings alone. Then if growth occurs, it is a bonus, not a necessity. Third, the mistake of overconcentration. Even with a margin of safety, individual stocks can decline further than you expect. Management can make terrible decisions. Industries can face unexpected challenges. Your analysis, despite your best efforts, can be wrong. Therefore, diversify. Own 15 to 20 different securities across different industries. This way, if one or two of your selections prove disastrous, the others with proper margins of safety will more than compensate. Fourth, and perhaps most dangerous, the mistake of abandoning the margin of safety in bull markets. When stocks are rising, when everyone is making money, when new investors flood into the market, it becomes tempting to relax your standards. You tell yourself that the old rules no longer apply, that we are in a new era, that you must buy now or miss out forever. This is the voice of greed, not reason, and it leads inevitably to loss. The margin of safety is not situational. It is not a rule you follow only in bear markets. It is the foundation of all sound investment in all markets at all times. Let me give you a practical framework for applying the margin of safety in your own investment decisions. Before you buy any stock, write down 3 numbers. First, your estimate of intrinsic value. Second, the current price. Third, your margin of safety as a percentage. If your margin of safety is less than 30%, do not buy. Wait. Be patient. There are thousands of stocks. You need only a handful of good opportunities each year. Even when the market declines, review your list of companies you have analyzed. Many will now offer adequate margins of safety. This is when you act, not when prices are rising and everyone is optimistic, but when prices are falling and everyone is fearful. Once you have bought with an adequate margin of safety, ignore the short-term fluctuations in price. The market will test your conviction. It will drop your stocks further. It will rise without you in other stocks. None of this matters. What matters is whether you bought a good business at a price well below its intrinsic value. If you did, time is your ally. Eventually, price and value converge. Sometimes it takes months, sometimes years, but the mathematics work in your favor. And here's a secret that few investors understand. The margin of safety actually increases in many cases as you hold the stock. If the business continues to earn money, its intrinsic value grows. If you bought at $50 and the intrinsic value was $80, but over 3 years, the intrinsic value grows to $100 while the stock only rises to $70, your margin of safety has increased, not decreased. This is why patience is so profitable. You are not merely waiting for the price to rise to intrinsic value. You are waiting for intrinsic value itself to grow, creating an even greater eventual profit or eventual. My friends, I have given you today the most important lesson I learned in a lifetime of investing. And the margin of safety is not merely a good idea. It is not optional. It is the only rule that protects you from losing money. Every investor who has suffered permanent loss of capital has violated this rule. Every investor who has built lasting wealth has followed it. There are no exceptions. The market will tempt you to abandon this principle. It will show you stocks that have doubled, tripled, increased tenfold, all bought without a margin of safety. It will whisper that you are being too conservative, that you are missing opportunities, that this time is different. Ignore these temptations. They are the siren song that has destroyed fortunes throughout history. Instead, commit yourself to this one simple rule. Never invest without an adequate margin of safety. Be patient. Wait for opportunities. When they come, and they always do, act with conviction. Do this, and you will sleep well at night. You will preserve your capital through market storms, and over time, you will build wealth steadily, safely, and surely. The margin of safety is the only rule that protects you from losing money. Follow it and you will be protected. Ignore it and you will eventually be taught a very expensive lesson. The choice, as always, is yours. Thank you.